Welcome back to this series of lectures titled A Brief History of Money, Banking, and Credit. I'm Edward J. Dodson. This lecture 4, is titled When All Hell Breaks Loose. We're all familiar with what eventually occurred. The credit-fueled and speculation-driven stock market crashed on the 29th of October 1929. Investors owed nearly $7 billion for stocks bought on margin. Less than 2 weeks earlier, one of the nation's most admired economists, Irving Fisher, had told an audience that stock prices had reached, quote, what looks like a permanently high plateau. By mid-November, billions of dollars of paper profits had disappeared. A growing number of the nation's banks, already financially stressed by losses incurred when speculators in Florida land defaulted after the mid-decade hurricanes, became insolvent and went under. And Florida was just one of the sources of bank losses, as explained by Frederick Lewis Allen. The Florida boom, in fact, was only one, and by all odds the most spectacular, of a series of land and building booms during the post-war decade, each of which had its marked effect upon the national economy and the national life. At the very outset of the decade, there had been a sensational market in farmlands, caused by the phenomenal prices brought by wheat and other crops during and immediately after the war. Prices of farm property leaped. Thousands of mortgages and loans were based upon these exaggerated values. And when the bottom dropped out of the agricultural markets in 1920-21, the distress of the farmers was intensified by the fact that in innumerable cases, they could not get money enough from their crops to cover the interest due at the bank or pay the taxes which were now levied on the increased valuation. Thousands of country banks, saddled with mortgages and loans in default, ultimately went to the wall. As country after country sunk deeper into recession, their reaction was to attempt to protect domestic producers by introducing tariffs and other protective measures. President Herbert Hoover signed the Smoot-Hawley Tariff Act into law in June of 1930. As one would expect, the world's other nations retaliated. As international trade contracted, the recession deepened. Another shock to the economy occurred in 1930 when a New York City bank, founded in 1913 by a Jewish immigrant to the United States named Joseph Marcus, began to experience cash flow problems caused by rapid growth after a series of mergers. By 1929, the bank had grown to become the third largest bank in the city. It then became public knowledge that additional merger plans were dropped because the bank could not guarantee the safety of deposits. A large proportion of the bank's assets were in the form of real estate mortgage loans. The name of the bank was the Bank of the United States. When the above information was made public, there was a run on the bank's Bronx branch. Runs on other branches soon followed, and the bank was forced to close. Depositors lost an estimated $550 million. Worse still, because of the bank's name, people all across the United States thought that the nation's financial system had collapsed. As the United States drifted from recession into a depression, Professor Harry Gunnison Brown made an attempt to argue the case for changing the way government raised needed revenue in a book published in 1932 with the title The Economic Basis of Tax Reform. He had no expectation that his call for change would find welcoming support. In the book he wrote, aristocratic economic relations must probably continue, even if they coexist incongruously with democratic political institutions. Indeed, the exploited masses are ordinarily in large part the dupes of the privileged interests as well as of their own ignorance, and support, through their own prejudices and their own votes, those very economic policies by which they are laid under tribute. Brown's work attracted the attention of Princeton University professor Denzil Klein, who wrote a substantive review of the book for the March 1934 issue of the Bulletin of the National Tax Association. Professor Klein acknowledges Brown's long-standing arguments in favor of public capture of the unearned increment in land, also noting that, quote, a large part of the economic theory upon which Professor Brown bases his argument is not accepted by many economists. He also offers another reason why Brown's analysis was mostly ignored. It is unfortunate that Professor Brown is so caustic in some of his comments upon other economists. He is particularly exasperated with certain authors who have not seen fit to give any extended consideration to the single tax in their texts upon public finance. This conspiracy of silence is taken as evidence that either these writers do not really understand it, or they are extremely biased against the single tax doctrine. A more proper interpretation might be that the single tax doctrine in its extreme form cannot be taken seriously. An extensive search found no other reviews of the book by Brown's academic colleagues. Remember my mention of Silvio Gesell? Well, in 1932, the town of Wurgl, Austria, began to issue stamp money as a way to combat skyrocketing unemployment and business closures. The town used this money to pay the unemployed to do public works. Other towns and cities adopted the system, including Hallerden, Iowa, and Anaheim, California. In 1933, Irving Fisher wrote a short book inspired by Gesell's ideas titled Stamp Scrip. Fisher urged Congress to institute stamped money to provide relief to a distressed population. Although a bill was introduced into the U.S. Senate to issue $1 billion of stamp money, the bill never made it out of committee for a vote. Even so, more scrip was issued during the Great Depression in the 1930s than ever before or since. The scrip was issued by municipalities, civic organizations, business organizations, and even individuals. A number of state legislatures passed laws allowing localities to issue stamped scrip. However, there were far more issues of scrip that did not have the stamp feature than did. Awaiting resurrection were the writings of theorists such as Alfred Mitchell Innes, who, beginning in the early 20th century, tried to make the case that money exists not as a medium of exchange, but as a standard of deferred payment. Government-issued money being debt the government could reclaim through taxation. As he explains in this article, that is to say, to satisfaction for the credit and on the obligation of the debtor to pay his debt, and conversely on the right of the debtor to release himself from his debt by the tender of an equivalent debt owed by the creditor, and the obligation of the creditor to accept this tender in satisfaction of his credit. While economists and reformers engaged in these exchanges of views, Americans decided the nation needed different leadership and elected Franklin Delano Roosevelt president in 1932. Herbert Hoover urged Franklin Roosevelt to work with the other leading industrial nations to come to agreement on a currency stabilization program and commit to remain on the international gold standard. Roosevelt decided the United States should act unilaterally. Rather than wait for the London Economic Conference scheduled for the summer of 1933, Roosevelt devalued the dollar and removed the United States from the international gold standard. When the economic situation worsened instead of improving, Roosevelt realized the mistake. However, it took until 1936 to reach new agreements with Britain and France. I've been unable to find figures on compliance with this executive order by President Roosevelt. Those who did turn in their gold were paid $20.67 per troy ounce. The following year, the government raised the price to $35, giving the government a significant windfall profit on previous purchases. Historians estimate that the U.S. government held some 6,000 metric tons of gold in 1933. At the $35 price per ounce, this brought the value up to $7 billion. As of March of this year, the United States government has 8,133 metric tons of gold in its reserves, worth $480 billion. The Congress passed the Emergency Banking Act on March 9, under which the Federal Reserve System was authorized to provide whatever cash was needed by banks deemed sufficiently strong to remain open. Between 1929 and 1933, nearly 10,000 banks across the nation failed. Important systemic reforms followed. One was the signing of the Glass-Steagall Act, which prohibited the mixing of banking, securities, and insurance businesses. The Securities Exchange Commission and the Federal Deposit Insurance Corporation were also established. With confidence restored by creation of the FDIC, the public redeposited nearly two-thirds of the $1.8 billion in currency they held. As the United States slipped deeper and deeper into an economic depression, a Republican banker from Utah, Mariner Eccles, arrived in Washington, D.C. to testify before the Senate Finance Committee. He held very strong views on what had brought the nation to its financial knees and what needed to be done. He said, "In the mad confusion and fear brought about by our present disordered economy, we need bold and courageous leadership more than at any time in our history, for the reason that our industrial revolution has made necessary a new economic philosophy, a new business point of view, and a fundamental change in our social system. Specifically, the operation of our money world has failed to be our servant and instead is our tyrant and master." President Roosevelt was urged by Secretary of the Treasury Henry Morgenthau Jr. to appoint Mariner Eccles as chairman of the Federal Reserve System. Soon after confirmation, Eccles embarked on reorganization of the Federal Reserve Board and began to promote the policies that would be cornerstones of the New Deal. At hearings held in March on the proposed Banking Act of 1935, Eccles explained why these measures were needed. The present need is to so modify our banking law as to encourage the banking system to give a full measure of cooperation to efforts at economic recovery. It is even more important from the longer time point of view to so modify our banking structure and administration as to have it become an influence toward the moderation of fluctuations in employment, trade, and business. This would tend not only to avoid the particular evils that came to a head in 1928 and 1929, but to so regulate underlying conditions as to diminish the possibility of a speculative boom getting underway. For when speculation is once underway, it is extremely difficult to control, and the only means of preventing excesses is to combat conditions that are favorable to their inception and early development. Although Eccles possessed no academic credentials in economics, his thinking on how to jumpstart the U.S. economy was interventionist and along the lines recommended in Britain by John Maynard Keynes. In an address delivered at the University of Pennsylvania on the 8th of May, 1936, he stated, "Obviously, what was needed to absorb excess capacity generally was an increased demand arising from increased consumer buying power. And here, it seems to me, is the crux of the matter. Increased demand could come about only as a result of increased incomes, and increased incomes depended upon increased disbursements by industry or by government or by both." Eccles got the centralization he sought so that whatever the Federal Reserve did would be uniform across the country to the extent thought desirable. Yet the nation's economic problems remained unsolvable all the way into mid-1939, as much of the world was already engaged in destructive wars of territorial conquest. Speaking before the Senate Committee on Banking and Currency, he reiterated what he believed to be the need for systemic reforms. The fundamental adjustment in our economic mechanism that is required is the establishment of a better equilibrium between the capacity of the country to consume goods and services and its capacity to produce them. As the threat of war among the European nations was realized, European central banks began to ship gold stocks to the safety of New York. Between June of 1938 and June of 1940, a total of 140 tons of gold were transported. Economists all around the world were now engaged in discussions about how to find the funds with which to wage war and at the same time create a financial structure that promised to facilitate the rebuilding of a world increasingly in ruin with every passing day. This effort would culminate in 1944 at the Bretton Woods, New Hampshire Monetary Conference. During the early 1930s, a young economics student at the London School of Economics named Abel Lerner became a leading proponent of the ideas presented by John Maynard Keynes. During the war, he developed the principles referred to as, quote, functional finance, in which he argued that government policy should be designed to obtain full employment and price stability, regardless of whether this increased or decreased public debt. Of Lerner's analysis, Keynes wrote in 1943, Lerner's argument is impeccable, but heaven help anyone who tries to put it across to the plain man at this stage of the evolution of our ideas. Lerner's influence over the thinking of some economists and reformers would have to wait. Much the same could be said about a young Hyman Minsky, who earned his Bachelor of Science degree in mathematics at the University of Chicago in 1941 and his PhD in economics from Harvard University. Minsky's research focused on the cause of speculation-driven asset bubbles and the role played by the banking sector. The list of voices crying out from the wilderness would continue to grow as the years came and went, and as the global economy suffered one cycle of boom and bust after another. But representatives from 50 countries met in San Francisco, California from the 25th of April to the 26th of June 1945 for the United Nations Conference on International Organization. Within this new organization was established an Economic and Social Council with a mandate to promote higher standards of living, full employment, and economic and social progress. There was no blueprint available for how these outcomes might be achieved. And with that, we've reached the end of Lecture 4.